Welcome, everyone. We just wait a couple more minutes for everyone to arrive. But while everyone is coming in, it'd be lovely to know where you guys are calling in from, and in particular, what sort of areas you're working in. So whether it's consultancies or within the banks, what particular area that you are coming in from. So just pop those details in the chat, and we'll be underway shortly. Thanks, Dale, for giving us your details in the chat. Yeah, those guys that have just joined, if you can pop in the chat where you're from, if you're from a bank, what sort of area you're from in that bank, just so we've got an idea of the people on the webinar. I think, Connor, when it gets to 3 minutes past, we can kick it off.
Sure, sounds good. Yeah, let's kick things off.
Okay, we're going to go. Okay, so I think very warm welcome to everyone that's joined the webinar this afternoon. My name is Andrew Brown, and I am an associate at Riskworx, and have been in the credit risk and actual risk management universe for quite some time, so over 20 years, having started way back in Standard Bank when Basel II came through. And I've been doing consulting work across a number of different banks in the risk and treasury and capital management space over the last 20 or so years. My background is I'm a chartered accountant, so not a quantitative person, but very interested in the way that the banks have gone about implementing Basel II and now Basel III, and Basel IV. And over to Connor to introduce himself.
Thanks, Andrew. Good afternoon, everyone. My name is Connor Williamson. I hold an undergraduate degree in finance and economics and an honors degree in finance from Wits University. I have also completed CFA Level 1 and FRM Part 1. I've been at Riskworx for just over 2 years now. In that time, I participated in the 2024 graduate program and have worked across credit risk regulation, IFRS 9, and capital-related engagements. I also assisted Andrew on the benchmarking exercise across the 5 IRB South African banks. In this exercise, we assessed practical readiness for Directive 11, not just from a policy perspective, but from an execution standpoint, including systems, models, and governance. And from today's webinar, we'll share a benchmarking-based view of where the industry really stands, what tends to be underestimated, and what good implementation looks like in practice. The content for today will be giving you a bit of context and the benchmarking exercise. We'll then go over the key findings from the benchmarking exercise and finally end off with some Directive 11 and onwards. And finally, we'll open up for a Q&A session. I must please ask, if you do have any questions throughout the presentation, please simply pop them in the chat and we will try and answer them there and then parallel to the presentation.
Thanks, Connor. And then also, if you would like to actually say something, just put your hand up and we'll unmute you. And you can also ask the questions there. I think if we keep this the session interactive, that'd be great. Yeah, so just kicking off things, in terms of like where this benchmarking came from, is actually one of the banks came to me and said, hey, do you know what the other banks are doing with regards D7 of 2015, which is the distressed restructure directive? And I said, well, I have an idea, but let me actually go out there and do a bit of a study as to exactly where the banks are with regards their plans for Directive 7. And I think subsequent to that, what we've seen is that was a proposed directive. There was an updated proposed directive that came through, and then finally in October last year, the PA actually released the final directive for distressed restructures. So it's now very much in play, and the banks need to prepare for that. So I think that's really the reg context, and also where this benchmarking exercise came from. The other thing is we did interview 5 of the IRB banks in South Africa, and the results, or the general results that we're going to share with you, are on an anonymized basis, because we did that, or the interviews were done on a confidential basis. In terms of the way that we went about this benchmarking, we carved it up into a couple of different categories. So we looked at the banks, we asked questions specific to these categories. So really looking at strategic foundations. So how is the bank approaching this? Are they doing it in a strategic way? Have they set up projects or programs around the implementation of D11 of 2025? We then also looked at the data and systems, or data and systems architecture. So how are the banks approaching this? Because that is a big component of the work that needs to happen. Then looking at governance and oversight. So obviously there's a whole lot of rules and there's policy that's coming down the line in terms of the guidelines for how banks treat and identify restructures. We had a look at how they're approaching that from a governance oversight point of view. Then on the technical side, so actually taking these rules that have come out of the directives. Oh, sorry, I'm back. Can you hear me? Yeah, we reference UTP, so unlikeliness to pay, DPD, days past due. Those are key measures in terms of assessing whether a credit has restructured or not, was a distressed restructure, and then also in terms of how they are implementing the changes that are required or will be required in their models. We covered IFRS 9, so the ECLs, the expected credit losses, and the capital impact, or the assessed capital impact that the banks thought they would have. And then lastly, just looking at it from a portfolio point of view. So we dealt with banks that are universal banks, meaning they have retail and commercial and also corporate components in their makeup, and what they thought the impact would be across those different portfolio segments. Okay, in terms of the timeline, so as I've mentioned, I mean, the first proposed directive came out in 2015 and was known as D7 of 2015. So a lot of time has gone by since between then and now. So that's over 10 years. And the final directive was actually issued last year, that's D11 of 2025, to be effective from 1 January and in 2027. And I think the actual the ongoing implementation takes the banks all the way through to 2031. Why I say that is there's a whole lot of models that need to be redeveloped or recalibrated, and the delivery of those models is going to be happening between now and 2031. Okay, in terms of assessing the actual readiness for the banks, this was the criteria that we applied. So ranging from unprepared, where the bank didn't actually have any plans or hadn't given much thought to it, all the way through to well prepared, where there is actually a project and there are plans in place, was the criteria that we applied to this benchmarking. In terms of the scoring context, just something to bear in mind when we do show you these results. It was based on 60-minute interviews with each of the banks. It was very much a point-in-time assessment based on the people that we did interview. So some people would have a natural pessimist or even optimist bias, and that would have come through in the answers that they gave us. So it is in a sense, there is some subjectivity in our interpretation of their answers to the questions that we posed to them.
Thank you, Andrew. Before we show you any of the benchmarking results, we'd like to get your view of where you think the industry stands. On your screen, you will see six benchmarking components, from strategic foundations through to portfolio impacts. For each one, we're asking you to rate how ready you believe the 5 South African banks are today on average. There's no right or wrong answer here. This is simply your perception based on what you're seeing in your own institution or across the market. We'll give you guys about 30 seconds to submit your responses, and then we'll compare your collective views to what the benchmarking data shows. Okay, time is up. Can we please close the poll? Okay, thank you very much. Alrighty, so going through some of the answers from the audience from today. From those amongst us, it was a consensus belief that for strategic foundations, they were rated to about 2.4 out of 4. For datum and system architecture, 2.1. For governance and oversight, 2.5. For technical implementation, 2.1. IFRS 9 and capital impact, 2.7. And finally, for portfolio impact, a 2.3. As you can see here, just the results for you guys to just take a look. What is interesting to see about this is that from the results, it appears that the audience feels that everyone across the banks is moderately prepared for Directive 7 and the results, which is not entirely off from our benchmarking results that we were able to take into account. Obviously, when we take you through the results, it'll become a little bit more clearer, but essentially, yeah, a lot of the results appear to say that it is about moderately off in preparedness. Let us now look at what the benchmarking data actually showed. So at a high level, the key message is this. Intent is relatively strong, however, execution is uneven. Starting with the strategic foundations, the industry scores relatively well. Most banks have recognized that Directive 11 is material, they've articulated high-level approaches, and there is clear awareness at senior levels. Where we do start to see a drop-off is in the data and systems architecture, which was correctly answered by the audience. This is the lowest scoring area in the benchmarking, and it reflects a consistent theme we saw. The scale of system change required, particularly around tracking distressed restructures, cure periods, and redefaults, is being underestimated. Governance and oversight sit slightly stronger. Policies and committees generally exist, but they are not yet consistently aligned to Directive 11 specific requirements across products and portfolios. For both technical implementation and IFRS 9 and capital impacts, readiness appears moderate. There's awareness of model and staging implications, but very limited evidence of parallel runs, impact quantification, or end-to-end execution planning. Finally, on portfolio impact, banks broadly understand where the pressure points will be, particularly in retail, but that understanding has yet to translate into system-ready solutions. Overall, the headline takeaway is not that banks are unprepared, it's that readiness today is conceptual rather than operational, and it's that distinction that becomes critical once implementation timelines start to tighten. So now, the obvious question after seeing those results is, why does this matter now, and why can't this be something that we deal with later? The benchmarking pointed to two critical drivers with regards to that. The first is retail complexity, which has been consistently underestimated across all 5 banks. What was initially thought to be a relatively contained regulatory change has turned into a much larger system architecture challenge. Tracking things like unlikeliness to pay and dates past due in a Directive 11 compliant way, applying cure logic, and identifying redefaults requires changes that many legacy retail systems simply weren't designed for. On top of that, behavioral scoring models, which underpin much of retail decisioning, were typically not designed to capture the full set of early warning indicators required for UTP identification under D7 and D11. In many cases, this implies model redesign rather than simple recalibration. The second driver is the 10-year delay since Directive 7. This has created a sense of implementation fatigue across the industry. Many banks feel they've been discussing this for years, and the Basel IV delays have further masked the urgency. But the key message from the Prudential Authority is that full compliance is not optional, and timelines like 2031 are widely viewed as optimistic once execution reality sets in. So while the intent is there, the combination of underestimated retail complexity and compressed effective timelines is what makes early action so critical. To understand why implementation is so demanding, it's useful to take a step back and look at what actually changed at a regulatory level. At its core, Directive 7, now Directive 11, represents a regulatory alignment moment. South Africa has formally aligned its definition of default with the European Banking Authority and Basel Committee on Banking Supervision standards, turning what was previously guidance-type principles into local enforceable requirements. Practically, this means that the familiar 90-day past due threshold is now only one part of the definition. It's been expanded to include a more explicit UTP framework, together with prescribed cure periods and redefault logic, all of which must be applied consistently across portfolios. That consistency requirement is key. It removes the flexibility banks historically had to interpret restructures and defaults differently across retail, commercial, and corporate books. And that's why this matters differently depending on your role. For credit risk modelers, this isn't just recalibration. It involves historic data relabeling and, in many cases, PD, LGD, and EAD redevelopment to reflect a revised default population. For ECL and impairment teams, tighter default definitions translate into stage 3 inflation and the need to revisit IFRS 9 staging logic to ensure alignment with regulatory default, not just accounting interpretation. For model validators, the focus shifts to validating new default datasets, testing the robustness of recalibrated or redeveloped models, and defending consistency. Finally, for our regulatory and risk oversight teams, consistent application of restructure and default definitions across portfolios is now a clear supervisory focus rather than a policy discussion. So the movement isn't about a single rule change. It's about system-wide consistency, and that's what drives the scale of implementation effort that we are seeing.
Okay, what we're going to be doing is taking you through 4 of the major findings, and just diving into those findings a little bit to give you some insights as to how we think the banks are dealing with this. So I think the first one is very much around the technical implementation. And what we heard from the banks is that they thought it was mostly, or the biggest impact would be in the retail portfolios, and in particular, things like, you can see the comment there, we thought it was a recalibration exercise, it's a rebuild. So some of the banks are aiming to rebuild their entire retail portfolio, which is a substantial amount of work that needs to happen. And if you can think about it, if you're rebuilding your entire portfolio, you then also need to validate all of those models, as well as then submit them through to the PA for approval before they can be implemented. On the technical side of things, in terms of implementation of all of these triggers, or these indicators that indicate a credit is in distressed restructure and then defaulted, there's a lot of work that needs to happen in the systems in order to build the data points in to then have these UTP triggers, as well as things like the days past due. And particularly given that this is retail portfolio, many of the banks are running legacy systems for their core banking systems, and the effort to actually implement those IT changes is substantial. So I think that was, very much around the complexity of implementation. I think something else is, if you are redeveloping an entire portfolio of retail models, there is the need then also to run these models in parallel with the existing models. So the infrastructure needs to be able to handle that, so that you can actually validate the models at the same time as running the existing or the current models. And then lastly, that other point there around, you have your default data sets. Now what has to happen is you've got to go back and review your entire performing book from the past probably 15 years, going back to 2008, the last downturn period, and assess whether there are any credits or exposures in the performing portfolios which should actually be classed as restructures, and therefore are defaults and should be in the default pool. And that is no easy exercise to do. I think moving on to the next slide. Just continuing on finding one, I think the portfolios, or what we heard, the portfolios where the banks thought the biggest impact would be home loans, credit card, unsecured lending. And as I've already mentioned, those indicators, the days past due and UTP, those would require some effort to actually implement and be able to track those figures, or those measures. why that's important is, if you think about it in a retail portfolio context, is you've got hundreds of thousands, if not millions of customers. So you can't do it manually. It needs to be done systematically across the entire portfolio. And you've got to build these tracking fields into your systems in order to identify these distressed structures, which are effectively or now classed as defaults. If there are any questions, please post them in the chat. Happy to answer them as we're going through the slides, if they're relevant to or as we move through, instead of just doing everything at the end. So, and yeah, I think this is really just a summary of the different aspects. So 90 days past due. There's certainly a gap there in terms of being able to track that. UTP, that needs to be scoped, and by scoped or spec'd, exactly how are the banks going to be doing that to identify or to calculate this unlikeliness to pay triggers. There is also the cure logic that needs to be built in, as well as the cure periods that need to be adjusted from their current periods to the new periods defined, or the 12 months defined by D11, and it needs to be done consistently across the bank. And then there's also the redefault flagging. So in many cases, I think the bank said, well, they would just treat a redefault as a new default, and not track that it had actually defaulted before. So there's some work to be done there. And then systems integration. I think all the banks have got many legacy systems that they are sourcing information from, consolidating it, and then using that to actually build their models and to monitor credit on an ongoing basis. So some changes needed in their base systems, as well as also in the credit scoring or credit risk systems or infrastructure that they're running. Moving on to okay, so the key findings there, just in summary: technical readiness, really understanding and working out how those rules are then applied operationally in the systems and the processes in the bank. And then the retail portfolio, just in summary, I think is where the bulk of the work, or the complexity, lies, and the bulk of the work is going to lie in terms of the technical implementation of D11. Okay, moving on to the finding 2 in terms of IFRS 9 and the implications on the banks. I think there is certainly some work that needs to be done there, and one of the things that banks need to be careful about is making sure that the definition of default between IFRS 9 and also the regulatory definition of default stay aligned. Things like your SICR thresholds need to be defined, not just in stress tested and also stress tested against D7. And then also, like anything, the impacts have been assessed, or they will only really be able to be assessed once the default pools have been built out with these new distressed structures, as well as also implementation of D7 in terms of working out what the impact is going to be on the ECLs. I think something else that we also found, and Connor's going to cover that a bit later, is that ECL did ramp up into COVID. ECL has now reduced over time to its current levels as the banks have all released provisions. Moving on to the next slide. Okay, so I think in terms of the impacts, or some of the impacts that we think D7 or D11 is going to bring to these ECLs, there may well be an increased migration from stage 3 into stage 2 into stage 3, which is obviously going to impact the ECLs as the provisions step up with that increase of migrations into stage 3. There may well also be some increase in volatility in ECL as D11 is implemented, and we would need to actually see, and this will only become evident as D11 is implemented, what the full impact is going to be. So yes, defaults may increase because more distressed structures are coming to the pool, but we may also find the LGDs reducing because these distressed structures cure at a faster rate. Although at the same time, we do have the cure period set at 12 months, which is going to delay the re-entry of these distressed structures back into the performing book.
Thank you, Andrew. Moving on to our third finding. The third key finding from the benchmarking relates to the ECL coverage trends, as Andrew mentioned, and what they imply as we move into a D11 aligned default environment. The observed pattern across the 5 banks is very consistent. ECL coverage ratios declined by roughly 40 to 80 basis points depending on the bank between 2019 and 2024. This reflects post-COVID credit normalization, improved portfolio performance, and the release of pandemic-era management overlays. Building directly on the ECL trend we've just seen, the key question is not whether coverage has declined, but what that means as we move into the D11 era. The strategic questions capture that challenge. As default triggers tighten under Directive 11, the first question is whether the compression we've seen in ECL coverage can realistically be sustained or whether it begins to reverse. That naturally leads to the second question. Are current IFRS 9 models calibrated to absorb potential stage 3 inflation, particularly where restructures trigger default earlier and remain in default for longer through probation and cure periods? And finally, have forward-looking overlays been explicitly stress-tested against stricter default recognition, or are they still anchored to a pre-D11 definition of default? When we look at what needs to happen, the benchmarking points to a clear set of actions. Parallel ECL modeling is critical. Banks need to run current assumptions alongside D11 aligned default assumptions to understand direction and magnitude of impact. That needs to be complemented by SICR threshold sensitivity analysis to understand how stage 2 and stage 3 migration behaves under tighter default recognition. And importantly, these outcomes need to be elevated into board-level scenario planning because the implications are not just accounting-driven. They directly affect capital planning and risk appetite. Essentially, banks need to consider moving from trend observation to deliberate preparedness.
Okay, and moving on to finding 4 is really around the resourcing constraints and timelining realism. So what we were seeing last year is that the banks were very much focused around the Basel IV implementation, and that's where budgets and resourcing was being focused. The other factor that was coming into play there was that we were still operating with a proposed directive. That has now become a final directive in October of last year. So the timelines have now been firmed up, and so have the regulations that have been put through in D11. In terms of the actual timelines for implementation, and that's the 2031 timelines for the implementation of all of these changes and the updated models that need to come through, I think the banks viewed this, or certainly the PAs timelines as being unrealistic given the quantum of work that needed to happen. And I think also something else that also came up was that the PA's capacity to actually approve models, which is currently under strain, is going to come under severe strain as the banks start to submit a lot more models or recalibrated models over the next couple of years. So we'll have to see how that pans out. And then from a resource demand point of view, what we also heard is that there's going to be demand, obviously, on bolstering the modeling teams, so the credit risk modeling teams, as well as the validation teams, in order to process all of the models that they're needing to redevelop or to recalibrate. As well as also, I think on the default or the historical data pools is actually going back in time and to restate those data pools and to look for any new defaults or new distressed structures that form part of the default data pool. That was viewed as being quite a significant piece of work.
Andrew, I do see we have a question on this in the chat.
Annette, so did Riskworx engage with the PA on their readiness capacity for the anticipated model submissions? Thanks for the question, Annette. No, we didn't. We did reach out to the PA. However, like their response was they don't really sort of take part in these type of benchmarking exercises. So we did reach out to them, but I suppose the feedback was no comment from their point of view. Okay, so just something else in terms of the capacity crunch. I think the PA certainly has big expectations in terms of what it expects the banks to do and to deliver. And there was that in terms of the roadmap, there's the list of models that the banks need to submit to the PA, and when those models are going to be resubmitted for approval. I think the parallel validation streams, those certainly need to be resourced. And the thinking there was that if we are redeveloping or recalibrating all of these extra models, there is certainly extra capacity that's needed on the validation side, as well as also the ability to run these new models in parallel with the existing current models. So there's some infrastructure resource requirements that are needed there in order to run these model sets in parallel. And what we saw in terms of like best practice from the banks is certainly looking at their capacity planning going into the future, the specialist resources that are needed to develop models and validate them, as well as also, I mean, there was an interest expressed by actually most of the banks to share learning opportunities across the industry. So as to how each of the banks are approaching their readiness for D11, and perhaps also in terms of the way that the regulations are actually being implemented in their respective banks. And yeah, I think most of them were also considering the use of outside service providers to help accelerate delivery for D11.
Thank you, Andrew. Before we move on, we'd like to get a quick sense of where organizations are at in terms of formal D11 project governance. On your screen, you will see a simple poll asking whether your institution has formal D11 governance structures in place. For example, a steering committee, defined ownership, or a structured roadmap. The options range from yes, established, through in development and planned, to not yet addressed. There's also a not relevant option if this doesn't apply to you. Again, There's no judgment here. This is just about understanding where the industry is collectively, especially given the scale of execution we've just discussed. Again, we'll provide everyone about 30 seconds to answer, and then we can just run through the results. Right, that's time. Can I please ask for the poll to be closed? Thanks. Alrighty, going through the results for this recent poll is majority of the people in the audience today actually said that they did indeed have established, about 37%, not bad. Followed by next in line was not yet addressed, 22%, evenly split between in development and planned, and then finally for 11%, not relevant. So it does look like for the majority, there is certain development that does need to be put into place.
Okay, I think just a summary across the different portfolios within the banks. So as I've already said, or we've already said, the biggest impact is going to be in the retail banking portfolio, particularly those portfolios that have home loans, credit cards, and unsecured lending. And there's rather large infrastructural architectural requirements that changes that need to be made to cater for D11. On the commercial side, probably a medium impact there. I think the highest impact is at the lower end of the commercial segment. So your smaller businesses that are relying still on your scoring or your application and behavioral scoring models. That's where the big change will be in that portfolio, but probably dealt with by the retail modeling teams. And then on the corporate side, there was fairly unanimous agreement amongst the banks that this is the area where there's likely to be the least amount of impact. In particular, I think when it comes to governance in the corporate side of things, and for the larger corporates, the banks run very manual processes there. So this is a case where you have fewer names, so there's a lot more scrutiny on those names and oversight in terms of determining whether they are actually distressed restructures or not. I think one of the challenges across these portfolios is very much to make sure that D11 or the requirements around distressed restructure are consistently applied across retail, commercial, and also the corporate banks or the corporate segments. And this is something that the banks are probably going to need to be able to evidence to the prudential authority when they do come along and assess the banks on the implementation of D11. Yeah, I think that in general is the view across the different portfolios in the banks. So just in summary, key insights that came out of there: retail changes, largest implementation risk at this stage, and the most work to do. And then that other point that I've just mentioned now is really around corporate governance consistency. So making sure that D11 is consistently applied across the portfolios in the bank, and being able to evidence that to the Prudential Authority when they do ask for evidence that the banks have complied with D11.
Thank you, Andrew. Up to this point, we've spoken a lot about readiness and impact. What we would like to now cover is what Directive 11 actually changes in plain language. At its core, D11 introduces a much stricter, more rules-based approach to default recognition, particularly around restructures. Firstly, it introduces explicit financial distress indicators. That means banks can no longer rely on broad judgment alone. There are now defined signals that must be assessed and evidenced. Secondly, there's a clear separation between business as usual restructures and distressed restructures. That distinction sounds simple, but in practice, it removes a lot of the flexibility banks historically had in classifying restructured exposures. D11 also formalizes an economic test for reduced financial obligation. Essentially, if the restructure is likely to result in a loss, whether through interest concessions, term extensions, or NPV reduction, default classification becomes mandatory. Importantly, this is reinforced by minimum probation and rehabilitation rules, which lengthen the time an exposure remains in default and reduces the scope for early exits. So the practical impact is quite significant. Many restructures that were previously treated as performing will now trigger regulatory default, earlier, more consistently, and across all portfolios. And that shift is what drives the downstream effect we've been discussing on ECL, capital, systems, and governance. Having just discussed what Directive 11 changes in plain terms, it's helpful to step back and summarize what the benchmarking consistently showed across the 5 South African banks. First, strategic intent is strong, but execution remains uneven. Banks understand the regulatory requirements and the direction of travel, but operational readiness, particularly across the systems and data, is still lagging behind policy awareness. Second, retail portfolios clearly emerge as the primary implementation risk. The complexity around unlikeliness to pay identification, days past due tracking, cure logic, and behavioral models is driving far more effort and system change than banks initially anticipated. Third, default, ECL, and capital impacts remain undermodeled. While awareness does exist, very few banks have actually run parallel ECL or capital scenarios using D11 aligned default definitions, which increases the risk of late surprises. And finally, timelines are widely optimistic once execution reality sets in. Data relabeling, system build-out, and validation capacity are seen to be consistently underestimated across the industry.
Okay, so some strategic takeaways for those of you from the banks in the audience. I think we've seen now D11 is a final directive, or it has timelines set around it. So it has actually it's a stake in the sand now. It does need to be implemented by the banks, and they need to obviously move on that because there are timelines attached, and as much as it goes out to 2031, there's a lot of work that needs to be done in the next couple of years. I think the real risk is not so much compliance, but really late or reactive compliance. So it's to put in the effort now to make sure that the banks can actually implement D11. And then lastly, I think, and it comes back to Connor's comments around sort of volatility, or really understanding what the impact of D11 is going to be on ECLs, on capital numbers, based on the changes that it is going to drive, or it's going to drive through. So best to get on top of those, understand them as soon as possible, and to implement the new models, or the recalibrated models, or the updated ECL models, so that those changes do then start feeding through into the capital levels and also the financial results of your particular banks.
Thank you, Andrew. With that, we'd like to now open up the floor to any questions that anyone might have. Please, can you simply pop them in the chat and we'll go through them one by one.
And if you would like to ask a question, you're welcome to put your hand up and we'll unmute you and you can ask your question or you can comment. Okay, Connor, I don't see any questions coming through. Let's just give it a couple more seconds. Yeah, I think, I mean, it was an interesting exercise, this benchmarking, to chat to the banks to see how they're approaching. It was D7 of 2015 at the time, and it seems just from the poll results of that second poll that the banks are prepared, or they certainly have projects or programs in place to address D11, and it's good to see that. So nothing like a final, or the actual directives to be issued, the final directives, which then provides the impetus for the banks to then start working on implementing regulations like this, which are fairly, or as you would have seen based on this benchmark, have fairly big implications for the banks, these IRB banks.
Okay, I don't see any other questions in the chat, so we're just going to close out the question segment.
Okay, and I think with that, thanks everyone for attending. I hope you got something, or we hope you got something out of this this benchmarking exercise, even if it was just that, well, there's a lot of work to be done and we need to prepare for it. And perhaps we raised a couple of points that aren't already in your plans. If you'd like to discuss this any further, please reach out to myself or Connor. Be happy to have a coffee and to chat about this directive and the way that you're approaching it in your respective banks.
Great. Thank you all for your time, and we wish you a fantastic rest of your day.
Oh, Becky, there was a hand up there from Becky. Ah.